Back to trading day, your call 1300 30 34 35. Your call at yourmoney.com.au. That's the way to get hold of us. So keep your market queries coming in. Let's first take a look at some of the top headlines today.
We'll let you know in about 3 or 4 weeks whether or not it was successful. You never really know, right? But I have a feeling it's going to be very successful.
U.S. President Donald Trump optimistic about a resolution to the China trade dispute, but the markets are not having the same confidence. However, as you can see there, the ASX down by about 63 points today. Earlier on, it was down by about 72 points. Now it's at 62.34. However, the Australian dollar ticked up ever so slightly on the back of that slight optimistic sentiment from the U.S. President there. The AUD up by about 0.2% now. Let's check in on the Shanghai and Hang Seng as the trade wars start to hit the global economy. Also a sea of red there in Asia. All except the Korean markets actually are doing pretty badly. Shanghai Composite, they're down by about 10%. The Hang Seng down 10 points down. Hang Seng down by about 430 points or so. Making news this hour, the latest NAB survey highlighting that business conditions and confidence are now sitting below their long-term averages. And ANZ's consumer confidence reflecting business conditions as it slides over an 8-point drop in economic conditions. Our panel joining me in the studio today, we've got Elio D'Amato from Lincoln Indicators and David Novac from Wealthwise Education. Carolyn has written in with an email, and Carolyn wants the panel's thoughts on Boral in relation to future growth and income, considering it has a presence in the US. Also, is Wesfarmers a buy in light of their PE ratio and their strategy to acquire a lithium player, considering rare earths are becoming unrare earths? That's a very interesting point there indeed. Elio, did you want to start us off with Boral first?
Yeah, just very quickly with Boral. Very difficult to find a good case for this particular business here, other than the fact they are in satisfactory financial health, Carolyn, so that's the good thing. And the latest period of earnings growth was quite strong, but continued slowdown here in Australia, plus lingering issues in regards to the US and the JV that USG Boral there continue to weigh on this stock. I think it's too hard to try to find a conclusion right now. Better opportunities elsewhere. Okay, all right. I'll come back to you on Wesfarmers. Your thoughts on Boral, David?
Yeah, look, I just the trend is not being your friend on this stock. From what I can see, just to bring up the chart now, yeah, it's been pretty awful. For that alone, I can't touch it. And look, there's no strong earnings growth there, so it's not. Yeah, it's not one for my liking. Okay,
all right. Wesfarmers, what do you make of Wesfarmers?
Yeah, well, we like that stock. Star income stock, yeah, lithium play or rare earths, depending. I mean, look, the main thing is that they're sitting on a wad of cash, and the market's been wondering for quite some time, what are they going to do with that money? Well, they've obviously shown their card. They're getting into what they're familiar with in regards to energy production, just a different type of it. They want to deal with the new age or new world type technology. Rare earths, that was always going to be a difficult one to get over the ground. I mean, Lynas is a bit of a cursed child when it comes to business, and, you know, trying to arrange that deal is going to be just far too hard. But Kidman seems to make a lot more sense. Price of lithium, though, has been low for quite some time, so this was an opportunistic bid from the company, although Kidman, I believe, have rolled over and have taken the offer, which is a pretty good sign. So it would appear on the surface that they've acquired a reasonable asset, and at least us analysts that are trying to, you know, have a look into the future are probably getting a stronger sense now as to what the company's going to do to generate the next leg of growth.
Okay, David, your thoughts on Wesfarmers?
Yeah, look at the right. I guess the jury's out on this one. I think for these acquisitions, particularly the Lynas one. Yeah, I'm not quite sure about that one.
Yeah, I don't think that'll get through.
Yeah, so...
I don't think they'll pursue it.
No, because, I mean, the thing that's important to note is that if there was a deal struck with the Malaysian government to deal with that, Lynas's share price today would be $8, not $1.50, right? So, you know, they went in low ball trying to remove the risk from it. Lynas's board's never going to accept that. So I just don't think, I can't see it happening.
Yeah, and I don't know if I'll be chasing the stock up here. I think I'd be waiting for a pullback to get in. You know, but Wesfarmers is a great company, and but just not at this price level for me.
Okay, thank you very much for your email. We want to move on to Robin now, who's calling in from Sydney. What's your question for the panel, Robin?
Oh, hello. Thank you very much for this program. It's been absolutely wonderful, and I wish you were continuing. My question is about something David said earlier about being a BHPer, which I think is me. And I wanted to ask, how do you balance percentage-wise for each stock, and what suggestions would you make for sector?
That is a very good question. Another really good question as well.
Another loaded one, yeah.
Well, did you want to kick us off?
Yeah. Look, I think great question, Robin.
BHP?
Yeah. Well, again, you've always got to have an exit strategy. You know, I think from when things change, like the fundamentals of a business and the technicals in the chart. I mean, when the chart tells you to get out or take profits or sell, or, you know, there's no harm taking profits at the right time, Robin. But it's really, I've just learned that you've got to know when to get in and, importantly, when to get out or sell when you have stop losses in place. But look, if it's a fundamentally strong company, like we just talked about CSL, you know, that one, you know, there's opportunities where you could have got in, got out and got back in again. But then that's more, you know, you've got to have more skills around you know, that technical aspect of knowing when to buy and when to sell. For a lot of people that don't have the time to do that and they want to just be a passive investor or be in a fund, like with Lincoln, for example. But getting back to Robin's question, how do you balance the portfolio and the sectors? Well, you know, that's a great question. I mean, you know, you allocate anywhere between 3 and 5% in a stock. You don't want to go into, you know, 10 stocks that are in one sector, for example. So you're obviously looking for sectors that are growing the fastest. I mean, we've seen the healthcare sector as one, definitely has been one of the strongest by far growing sectors in the last decade. You've got other sectors that, you know, like, you know, more recently you've seen gold, the gold sector outperform, so that's another sector. Then you look at, well, the banking sector was a really strong growth sector, but that's come off the boil, so you rebalance your portfolio there. The resource sector has been certainly, for a lot of fund managers out there, they missed that move up in the resource sector with the likes of BHP, Fortescue, Rio. I mean, you know, fortuitously, you know, there's the Vale disaster. No one could have predicted that. But again, that's a sector that's been hot, you know. So you've really got to pick your stocks in the fastest growing sectors and then weigh it, balance it out, and allocate 3 or 5%. Some people go up to 10%. You know, that's pretty aggressive. I mean, we had a caller earlier that was talking about having one stock with 25% of his portfolio. That's obviously out of kilter, you know. So yeah, like that, Robin. That's the really, you know, you don't want to have all your eggs in one basket, basically, and you want to have your stop losses in place and exit strategies, knowing when to get out when things turn pear-shaped.
Okay. Elio, how do you decide what the percentage and what the sectors are that you get into?
Yeah, this is where I get a little bit controversial, Robin, because we have a very different definition as to what being diversified actually means. Yes, it means you're holding, you know, a portfolio of at least 15 to 20 great quality businesses aligned to your investment objective and your tolerance to risk, but we don't pay any attention to sectors. There's a famous saying from Warren Buffett, you know, that people who benchmark against sectors are people who don't know what, or people who diversify across sectors are just people who don't know what they're doing. We take a bottom-up approach to investing in stocks, and quite frankly, we find that if you find great businesses, you'll just get a naturally diversified portfolio of great companies. And yeah, you will be at times pointed towards sectors where you just get a larger percentage of good companies. As David correctly articulated, gold's been one of those, healthcare's been one of those. The other I'd throw in there is IT, with stocks like, you know, Appen and Altium, and prior to that we had WES.AX, which we've just recently removed, but they were also a key driver of the strong returns we generated there. So, you know, if you find great businesses and you have the means of being able to identify them as a priority, then you don't have to worry about the sector stuff, because the great businesses will bubble to the surface and they'll be spread all over the place. Now, when it comes to rebalancing or balancing out the portfolio, you know, much like we had earlier with the call, I think it was Ron, who had the 25% in CSL. You know, you can't, in that sort of instance, you do need to be ensuring that, you know, if you're holding 15 stocks or 20 stocks, then when a stock gets over 10% of your over a portfolio, it becomes quite concentrated. You can take those profits, use them to either build that war chest for future opportunities, or you could rebalance them into a stock that is still quality but might be just recently unloved. So unfortunately the show isn't long enough to discuss all the nuances, because what we're talking about now is strategic portfolio management. It's all great and good that mugs like David and I say, yeah, buy this stock, sell that stock, but a buy for who? Who's the, when someone says that you got to buy something, someone's got to believe just as passionately somewhere else on a computer screen somewhere that it's a sell. Otherwise you'll never get a trade. So those issues are very much quite more detailed, but the good news is it's not hard, and it's not about what we think, it's about what relates to you, and that takes a bit of work, and by all means contact our office and we can help you get started on the right path today.
Robin, great question. Thank you so much for your question. We want to move on to Peter now, who's calling in from Townsville. You have a question on Sundance Energy, Peter.
Yes.
Peter, you there?
Sundance. Yes. Sundance and BPT. Beach.
Okay. All right. Sundance and BPT. Shall we kick off with Sundance?
I know a bit about this one, Peter. Sundance, I've mentioned it in the past. Look, here's a really good example of what I was saying before about really disappointing management. The management of the company really did a poor job with burning shareholders' funds and diluting shareholders. And I was very critical of the company about over a year or so ago when they continued to do rights issues and dilute shareholders and just burn through cash. I mean, look, they've had this this big acquisition that they made last year in the US and Texas. They're in the all the shale oil region of South Texas. They acquired a company called Pioneer, and so they've got a fairly big acreage. They're up to about 14,000 to 15,000 barrels per day, but they're still, to this day, not cash flow positive. Now, they're expecting to be by the second half, and they've scaled that back. First they had projections of 22,000 barrels exit by the end of this calendar year. That's now more likely to be 15,000, 16,000. But look, this company's just done a great job at just spending and lots of money and then write-offs. And so look, the trend is not your friend as well, but the oil price is in their favour. They have locked in hedging, but let's see. I'm waiting to see their cash flow reports in the second half, particularly to the latter quarter of the year, to see that they're actually producing cash flow, like positive cash flow, and return something to shareholders rather than diluting shareholders. So I've been very critical for that reason.
Do you share the same opinion on Sundance?
Oh, I can't really add much to that because, funnily enough, prior to that they were financially unhealthy. So no, we weren't exposed to them, so I can't really add there. With regards to Beach, though, they're an interesting scenario because they made that rather large acquisition of the lattice assets off Origin, and the oil prices worked in their favour so much so that they've actually been able to, or they're expected to in this quarter, repay the entire debt payment back to that. So they're sort of playing with free money now, and now one of our major oil plays. But obviously commodity driven, so when oil prices go up they'll do well, vice versa they go down, and those sort of cyclical businesses, it gets a bit of a challenge. To touch on a point that Scott mentioned earlier in the first half of the program, where he said, if you'd invested in gold you really haven't done well over the long run. Well, yeah, that's true if you're looking at the physical asset, but if you look at companies that are able to increase production and do those sorts of things, then you'll get the growth. So yes, in regards to oil, Beach had a very stellar run because they increased that production. Now everyone's asking where next. That'll be where the challenge will be for Beach if they're going to get that next leg up. Otherwise their price will be beholden to what oil prices do.
Okay, currently Beach is trading at about 196 today. Peter, thank you very much for calling in from Townsville. We want to move on to another caller now. This is Alan, who's calling in from Sydney. Your question for the panel, Alan.
Thank you, panel. Can you please educate me or teach me where I'm possibly going wrong with two small caps in energy, being Ramelius, RMS, and Jupiter Mines? I've been watching those two stocks for a long time, reading up on them, and they seem to have all the credentials for success. Ramelius has done very well, but not necessarily Jupiter's. Thank you very much.
Okay. Elio, do you know either of these small caps?
Well, yeah, Ramelius is a gold miner, and their price has, pretty much, much like a lot of the gold stocks, has rallied quite strongly on the back of that. Jupiter Mines, no, unfortunately, no, I'm not across, and without my internet connection, I'm sort of floating here. So I might go to David and see if I can rectify my little issue.
Okay.
Yeah, look, Jupiter, well, let's start with Ramelius has been one of my favoured stocks in the gold sector, and, it's had a fantastic run. I mean, it was down around, it was about 40 cents or sub 40. I actually got into Ramelius when originally it was 11 cents, 11.5 cents, and been in and out of it. But I still like Ramelius with the gold price going up, and it's had a nice bounce. But in regards to Jupiter, I'm just having a look at it right now. The market cap of this company is about 590 million. And just having a look at their manganese mine, flagship mine is located in South Africa. They seem to be, they're strong. There seem to be pretty strong fundamentals just looking at the company here. I'm having a look at their earnings multiples, and I mean they've got a low earnings multiple, but they seem to be, look, I don't see anything. The return on capital seems to be quite high, so I don't know why Jupiter's, I'm not very familiar with this one. It has pulled back on the chart here. It had a pretty good run from February, from the lows there just below 25 cents up to 35. They pulled back to about 30 here. The trend is uncertain at the moment, so it's not. It was bullish, but now it's definitely uncertain. So for that reason, they've had a gap down here. I don't know why that was the beginning of this month. For some reason, I have to look into that if they announce something in that regard. But look, without knowing much more about it, just on face value, it looks pretty good fundamentally, Jupiter. But the technically speaking, it's not saying to me right now to rush in and buy it until we see a change of trend back up again. Yeah. But I'd like to look into it a bit more, especially wide gap down at the beginning of the month.
Yeah. Right. Well, it says here it was trading ex-div.
Oh, okay.
And that's why.
Yeah. Interestingly, though, the short interest on the stock's gone up a little bit. I noticed it's actually gone up to around 2%. So that success and now being profitable has got the eyes of some of those shorters out there who may be thinking, because they did realise the sale of a few of the iron ore assets, I believe, to focus, as you said, on the South African manganese project. So there may be some people just positioning there, but yeah, can't really add much more than that.
Okay. Alan, thank you so much for calling in, and do keep your calls coming in.